Good morning. It's time for Trading Hour, the final time this week in a week that has been a week of consolidation. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Patakia. With me today is Ekta Batra. Ekta, good morning. It's been a week that we've gone nowhere on the index, right? And even today, we are at the lowest point of the day. We are expecting an MSCI adjustment as well towards the end of the day. So there's a lot to track.
Hi, Hormuz. Yes, absolutely. And not to mention that, it is the fag end of the earnings season. So we have a lot of action which is happening in the broader markets in terms of specific stocks. But I just want to take you through the larger movement of the market on a week-to-date basis. Like Hormuz mentioned, it's been a week where we haven't seen much movement. So on a week-to-date basis, we have the Nifty, which is just about down by around 0.5%. We have the mid-cap index, which is outperformed with a gain of around 1%. A lot of stocks in focus, and that seems to be the theme playing out. Bajaj Auto, top loser on the Nifty today. Apollo Hospitals, which is managing to hold on with a gain of around 0.5%. It does come out with its numbers today. So let's see what it reports, because it's going into its numbers relatively stronger. We have Suzlon, which reported numbers, and the stock, as you can see, has outperformed up around 10%. Alchem Labs under pressure as its guidance is weaker than what the street had anticipated. So a lot taking place in the market in terms of specific stocks.
Earnings reactions, yes, and there are a lot of others as well, right? With the 9 new F&O entrants that we have in today's trading session as the start of the June series as well. Bharat Dynamics is one of them, and that is at a record high in today's session, the first day in the F&O as well. So 6% higher on Bharat Dynamics. Can't say the same for Masgaon Dock. Another first day in the F&O, but results were disappointing, although they met their FY25 guidance. But the fourth quarter results weighing on the stock price, 5% lower, is slight recovery from the lows that it had made at the start of the trading session. So Masgaon Dock is the other one that we need to track. We'll hear more from the management during the earnings call later this evening. So it'll be interesting to see what they have to say. The other positive earnings reaction, though, is Gujarat Pipavav of Ports, and that is among the second top gainers on the Nifty 500 index. The numbers on a year-on-year basis were flat, but even after that, the stock is up almost around 8.5%. So good going for Gujarat Pipavav Ports in today's trading session. So these are some of the earnings reactions, but also on the other earnings side, we also have some other stock-specific movers, which is Muthoot Finance is one of them. That has now surged to the highs of the day, 6% higher on Muthoot Finance after the FinMin suggestions that came in on the gold loan lending guidelines. So good going for Muthoot Finance. And a lot of these other smaller pharma names, be it Aster DM, be it Wockhardt, be it Concord Biotech, all of them doing well for themselves in today's trading session, Ekta.
Yes, absolutely. Like I mentioned, Alchem was one particular stock which really stood out. The company is just about guided for high single-digit overall revenue growth in FY26 and an EBITDA margin which would be flat in FY26. They've guided, however, for a pickup in FY27 to around double-digit growth. Wockhardt, there's been a turnaround which has taken place on the bottom line. The losses are lesser on a year-on-year basis, a bit of a tongue twister there, and it's a loss versus a profit Q-on-Q, but year-on-year it's a lesser loss. We have the margins which have come in at 9% again versus a negative EBITDA year-on-year. So that's the reason why you're seeing Wockhardt higher in today's trading session. That stock up around 5% odd. Concord Bio also revenue up 35%, margins 44%, improved 200 basis points year-on-year, and a profit which is up around 48% as well. So overall, doing well for even Concord Biotech, and it's looking good in terms of specific stocks at this point in time.
Yeah, some of the PSU names as well, right? A lot of these came out with results yesterday other than Masgaon Dock. But look at ITI, that's down in a 5% circuit. SJVN is down 5% after its results. NMDC Steel is down 4%. So it's not a very good day for the PSU names, at least. SJVN is now down to the lows of the day. NMDC Steel too. And ITI is another one that is locked in a 5% circuit. That too had seen a sharp up move earlier in the week. So on the other side, though, another PSU that's doing well after its results is Engineers India. It has a very strong operational performance during the quarter. So Engineers India is one of the PSUs that are bucking the trend. But the other one, though, and is another pharma name that has not done very well for itself through the year, and that is Orchid Pharma. Ekta, what more do you have on that for us?
Well, it's really underperformed post its Q4 numbers. The stock is down 20% this week at current reckoning. It's lost around 66% of its market cap this year. So it's been quite an underperformer for Orchid. Now, if you look at the numbers on a Q4 basis, the margins came in at around 11.8% versus 13.3% year on year and versus 12.1% Q on Q. So there's been a dip in terms of the margins year on year as well as Q on Q. And that was due to reasons such as higher cost on account of plant inspections, as well as a drag in the antimicrobial solution segment that they have. Now, Nuvama looks at the company and they've said that the base business price pressure has led to a muted FY26 guidance. They face key challenges such as a delay in key projects such as the 7 ACA, and that would be a delay by 3 to 6 months according to them. They have an NCE royalty ambiguity, which is a new chemical entity. There's a royalty ambiguity on that aspect according to Nuvama, and the Dhanuka Labs merger is near completion, which may propel revenue according to them. So the value, the value of the base business according to them is at around 25 times FY27 PE versus 28 times earlier. They've cut the target price to 990 versus 1570, but they've maintained their buy call on Orchid Pharma. It's been a continuous downtick for Orchid Pharma, in the past 7 odd trading sessions. Maybe a chart of the past 7 trading sessions will give you a sense in terms of how the stock has performed.
Indeed, not good going for Orchid Pharma, one of the few pharma underperformers in today's trading session. So, and of course, through the week as well, as Ekta was highlighting. But earnings reactions, we are counting down to the closure of this quarter's earnings season, and we continue our conversations with companies that reported results. Century Plyboards is one of them, a 13% revenue growth. Margins also contracted from last year. Its profitability was also under pressure. To discuss more on this, we're being joined by Keshav Bhajanka, the Executive Director at Century Plyboards. Keshav, good morning. Thank you for joining in. If you could help us more with regards to the internals of the quarter with the plywoods business, the laminates business, the MDF business. How have all of them fared? How have realizations been? And what is the road ahead for these businesses this year?
Sure. Good morning. Thank you so much for having me on the show. I think that in an overall muted demand environment, we have done reasonably well. On the growth part, I think we have done better than what most people had expected, considering building material as a category is under tremendous pressure. If you look segment-wise, in plywood, we have had close to a 10% growth, which was as per guidance given by us for the quarter. For the year, growth has been even higher. If you look at the laminate segment, we are finally back to growth, even though growth has been negligible on a console level. Plywood margins have looked up. We have guided for 12 to 14%, and we have managed to overachieve that for the quarter. And for the year, we are well within the range that we had defined. Laminates margins are off, and we have invested substantially over the course of the last 2 years towards growth, but that growth has not come. Hopefully, in the current year, we are looking at a 20% plus growth. With that, there'll be recovery in margins to high single digits for the current year. MDF segment has performed reasonably well, given the overcapacity situation in the market. Standalone basis, we are close to 20% EBITDA margins. Console basis, we are close to 13.5% EBITDA margins. Particle board segment continues to suffer because of overcapacity in the market. And I think till we commission our new plant, which is likely to get commissioned by the end of this current quarter or early in the next quarter, we will face headwinds in the particle board segment. However, steady state margins in the new plant should be close to 15%. With capacity utilization ramping up towards the second half of the year, in particle board, we should be back at high single digit margins in H2. Overall, I think from a growth perspective, we are quite well placed, but the margin pressure remains.
Okay, all right. Margin pressure remains. It's a cautious outlook, Keshav, I would say, for FY26. Before we get to specific numbers for FY26, I just wanted you to just elaborate a little bit on the muted demand scenario that you started this conversation with. Tell us a little more about it. What is this muted demand? Which segments are you seeing it from? What is it as compared to last year? And what are you projecting?
Sure. I think, for the building material sector overall, the new launches that were supposed to hit the market post-COVID and after COVID, there was a lot of, I would say, perhaps revenge buying where all the unsold inventory was sold off in terms of houses that were available. The new supply, I think, is yet to hit the market, and you will see that as a reflection across most building material companies. So I think that as this supply starts hitting the market, perhaps towards the middle or the end of this year, we're going to see a revival in demand. Currently, there is a muted scenario. I think the high interest rates, which lead to higher EMIs, have also played into the same theme. But hopefully, by second half of this year, we will see a buoyancy in terms of building material demand overall. Category-wise, I think all our segments other than laminates have done well in terms of growth. Particle board, of course, the new investment will come on stream only towards the end of this quarter or the beginning of next quarter, and that will propel growth. But other than that, plywood and MDF have done reasonably well. And I think for the current year, our overall growth guidance of 15% on a consolidated basis will be met.
What does that do to margins, Keshav? You mentioned that the demand outlook is pretty subdued. But in light of all of this, where do you see margins going in for FY26? You've managed to close the fourth quarter at 11.2%. Do you stay above double digits? Do you improve from this figure and go to, say, mid-teens? Where do you see margins this year?
I think we should see a definite uptick in margins without fail. Guidance or our objective will always be to work at 15% plus console, and I think by H2 we will reach that. Like I said, there are a lot of new capacities we have commissioned. For instance, the Budwell plant, which has MDF, which has laminate, which has PVC with close to 1,000 crore capex. So, it takes some time to scale up and to reach capacity utilization. Particle board, again, will be a lag for the current year, given that we are commissioning only in the first half of the year. So, I think towards the end of the year, we will definitely be at 15% plus. And going forward, we will be looking at higher margins for sure.
Since you mentioned it will take some time to scale up, when do you reach peak utilization for these new facilities that you have commissioned? And since you the particle board unit as well in Chennai, when do you reach peak utilization, and what are the kind of revenues that you're anticipating from them in FY26?
So as I've already said, MDF will be looking for close to 80% capacity utilization within the current year itself. We will be clocking 20% plus growth. For particle board, we should be at 50% capacity utilization for the new capacity towards H2. But reaching higher capacity utilization will definitely, or 70 to 80% will definitely take next year. Because again, we'll have to create the market, we'll have to ramp up. We are increasing capacity from 250 cubic meters to 800 cubic meter capacity. So that's a massive jump. But we'll definitely have 40% plus growth in the current year in particle board as well. And going forward, next year, we should be at a reasonably high capacity utilization.
Okay, reasonably high would mean what?
Next year, we will be looking at 75% plus for particle board.
And what would all of this do to price and pricing in your particular segments?
I think in terms of pricing, the oversupply scenario in the market is preventing a pass on of the raw material cost increase. However, having said that, we have worked on a lot of cost cutting initiatives. If you look at MDF on a standalone basis, 20% EBITDA margin has been primarily driven by a slight uptick in price, but a substantial saving in cost. And I think when times get difficult, it is when you work on cost, when you work on efficiency. So long term, it is going to be very beneficial. But pricing currently in the market, I don't see substantial increases because we are in an oversupply situation. Maybe towards the second half of the year, we would be in a position where price increases start.
Okay. Just a quick word on your debt figures.
So, debt, I think we are at peak debt already. Like I said, after the particle board plant commissioning, we have no substantial capex. We have a new plywood capacity that will cost anywhere between 100 and 150 crores. But we have no major capex plans. And from now, the debt repayment cycle starts. Hopefully, towards the end of FY27, we'll be back to zero long-term debt.
So by the end of FY27, you are expecting to be zero long-term debt, Keshav, right?
Yes.
All right. Okay, and what about your market share? What is it currently? Where do you anticipate that to go to, considering you have a slew of new capacities coming up?
I think market share, we need to see capacity by capacity. We need to look at different segments. So plywood, we are the market leaders and we have definitely gained in market share. As you can see, our growth is double digit plus, whereas the industry, I think, would have been low single digits at best. Exact market share figures are difficult, but I think in all the segments we are operating in, we are going to rapidly increase our market share. MDF, with the industry growing at single digits, at mid 15-20%, teen digits, we have grown at 40% plus. So again, we have taken market share. Particle board and laminates, yes, we have struggled, but these segments as well, I'm looking at higher market share gains over the course of the current year.
Okay, so just before we let you go, Keshav, let's just summarize what FY26 and FY27 is going to look like. FY26, you are looking for double-digit growth in terms of the revenue, but the margins are probably going to be pressured. FY27 probably is more of a year where things would look better on the P&L and the balance sheet. You're guiding to increased capacity utilization as well as lower debt. Is that how we would read it? FY27 would be a better year than FY26?
I think the way to look at it is that FY26 will definitely be a better year than FY25. FY25 was when the bulk of the new capacities came in, and FY27 definitely will be a much more profitable year with the new capacities having scaled up.
All right, Keshav, thank you so much for sparing time joining us today. Wish you good luck for the rest of the year as well. Management there of Century Plyboards, hoping that FY26 is a better year than FY25 and FY27 a better year than FY26. The stock, though, still at the lowest point of the day, 2.5% lower on that stock. Take a short break. All things commodities on the other side with Manisha Gupta. Welcome back. Time to focus on the commodity space. Manisha Gupta is now joining in to talk more about crude oil prices ahead of the all-important OPEC meeting, Manisha.
Oh, well, yes, and ahead of that, we are headed for a second weekly decline when it comes to the crude oil prices. One OPEC Plus ministerial meeting is already done and they've kept the output untouched. But 31st May is going to be an important one because OPEC 8 Plus are meeting here and they would perhaps decide on what really happens in sense of output for the month of July there. As of now, the street is anticipating an increase in production anywhere between 300 to 600,000 barrels per day there. Well, the markets also are reacting to the weak GDP numbers from US, the first contraction that we've seen in last 3 years. And add to that, the US jobless claims as well, which also are the highest in many, many years. So a couple of factors which are weighing onto the prices. The other thing is about the US crude inventories, which have seen a decline that tells you that the summer demand season is looking slightly positive because we've seen a decline rather in oil and distillate inventories there. The markets also are reacting to the IEA statement, which has warned of weak demand going forward in case of China. Also, potential new US sanctions on Russia is yet another thing that seems to be weighing on to the markets. So we haven't been able to hold above that 65, 66 mark. Every time we see the crude prices going there, there is an immediate profit taking coming in. And that's exactly the case right now as well.
Okay, all right, Manisha. Thanks very much for that. We'll take a short break, but once we come back, we'll discuss market technicals. Mitesh Thakkar will be joining in. Welcome back. Well, for the markets, it's very quiet. We have the Nifty just about lower by around 67 odd points. It's the first day of a new series. We do have the mid-cap index, which is down around 54 odd points as well. But I just want to point out that Shalby is the one which is actually under pressure at this point in time. That particular hospital company reported numbers late last night, so is reacting to that. The revenue was at around 265 crores, so that wasn't the problem. It was lower year on year, but the margins have come down to around 8% versus 16% on a year-on-year basis and versus 12% sequentially. And they've expanded their losses sequentially to 11.8 crores versus 5.7 crores Q-on-Q and versus a profit on a year-on-year basis. In fact, this is the largest loss that they've recorded ever. They've never recorded a loss as big. They've never recorded a loss for multiple quarters. Past 2 quarters they have, and this is now even larger than the previous quarter. So on record, it would be a multi-quarter low in terms of the bottom line. So that's what's taking place on Shalby. That stock down around 3.5%. But there are several other stocks like that. Gujarat Pipavav, Shobha, Landmark Cars, Amara Raja, Wellspun Living. They all are in focus on the back of their Q4 performance. Sudarshan is here to tell us more.
We'll start with companies which are reacting positively to their earnings for Q4 FY25. First on the list is Gujarat Pipavav, which has reported a steady set of earnings in this challenging environment. Revenue was at rupees 250 crore, almost flat. Even EBITDA was flat at rupees 157 crore. Company has managed to hold on to margin above 62%. It has come in at 62.3% against 62.6%. Second in the list is Shobha, which has reported a healthy Q4. Revenue was up 63%. EBITDA too has increased by more than 52%. And collections were higher by 21% and sales value has increased by 32% on a sequential basis. Now coming to the stocks which are reacting negatively to their earnings for Q4. First on the list is Landmark Cars. It has seen a healthy revenue growth, but margin has contracted. Revenue was up 26%. EBITDA too has increased. It's a minor increase of 2%, but margin has slipped by more than 120 basis points. Amara Raja, it was an operationally weak Q4. Profit was down 30%. Revenue has increased by 5%, but EBITDA has fallen 17%, and margin too has contracted by more than 300 basis points. Wellspun Living continues to see a moderate growth. Revenue was up just 3%. Margin remains under pressure. It was down 200 basis points. Company has reported FY25 revenue growth of 9% against its guidance of 10 to 12%. Also, company has not given any guidance for FY26, and that's the reason there's a sharp downtick that we are seeing in Wellspun Living as well.
A lot of soft earnings reactions. Sudarshan, thanks a lot for that. No guidance as well from the company for Wellspun Living. So not good going for that. But there are some positive earnings reactions as well. By the way, since Ekta was highlighting Shalby, not only is the stock at the lowest point of the day, but it is also trading below its IPO price, which was 248 rupees. The IPO had come out in December of 2017, so it's trading below that level now. Currently at 189 is Shalby. But Mitesh Thakkar joins in for a quick chart check. Mitesh, good morning. Thank you for joining in. You mentioned in our previous interaction that you're expecting the index to grind lower towards 24,450, 24,400 levels. Do you still maintain that view, considering the fact that we are still managing to hold on to that 24,700 mark on the downside, and your stock recommendations as well?
Almost my view isn't negative. I'm saying that the markets will most likely consolidate between these range, and I think in the worst case scenario, one of these days we could test those levels on the downside. So I think it's a market which is just chopping around between the 600 point range, 24,500 to about 25,050, give and take a few points, and this consolidation might last for a few more days.
And your stocks, Mitesh?
I have a buy on Pidilite. I think that's a stock which is showing good traction. So buy here, the stop at about 30.40 for targets of 31.40. And ONGC is a negative call on the sell side. Keep a stop at 245. Look for targets of 232.
All right, Mitesh, thank you so much for sparing time and joining us today. And we look to have you back later in the day. Take a short break. Up next, we get you market fundamentals with Nilesh Shetty of Quantum Advisors. Stay tuned. Welcome back. 65 points lower on the index, but Suzlon continues to go on its merry ways, 10% higher on that stock as well. And after a very strong fourth quarter result, of course. And Vivek is now joining in with the fine print of those numbers. Vivek.
Well, Hormal, like we discussed last evening, it's a very, very strong set from Suzlon this time around. FY25 has been a stellar year as far as deliveries are concerned, especially for the newer range S144 wind turbines. Now, looking at the numbers themselves, revenue is higher on a year-on-year basis by over 73%. We are comparing Q4 of this year to Q4 of last year. EBITDA higher by 94%. EBITDA margins up 200 basis points at 18.4% versus 16.4% last time around. Profitability aided by a tax deferral gain of close to 600 crore, but despite that, profitability remained very healthy for Suzlon this particular quarter. Now, talking about the volumes, volumes in this particular quarter at close to 573 megawatt, up both on a year-on-year as well as on a sequential basis. FY25 order book quite healthy at 5.6 gigawatt, almost 12 to 18 months of visibility, especially from this particular order book, is what the company has indicated. More importantly, this particular order book of 5.6 gigawatt, 91% of this order book is from the newer range S144 wind turbine, which is contributing close to 91% of the order book, indicating that structurally Suzlon can now be able to enjoy higher margins. For the first time ever, the company has also given a guidance as far as the full year of FY26 is concerned. WTG volume deliveries, revenue, EBITDA, as well as profitability, all of it is expected to grow by 60% on the base of FY25. Along with that, the WTG segment contribution margin has been guided at 23%, along with the O&M margin, which is expected to be much higher. Suzlon is set for a structurally higher EBITDA margin band as well. No wonder then the street clearly likes it, up over 10%, and quite a few EPS upgrades too coming in, especially from brokerages today.
Okay, all right, Vivek, thanks for that. Well, we also spoke to the management. Listen in to what they had to say.
Obviously, for the first time in our history that we gave a guidance saying that in FY26 we will grow by 60% minimum across the board. So that is not just giving a guidance of a number, and we are able to give a guidance for the first time, shows that we are now well prepared as an organization to see the future.
The management of Suzlon, bullish commentary after strong results. To take this conversation forward, Nilesh Shetty from Quantum Advisors is now joining in. Nilesh, good morning. Thank you for joining in. I'm sure you heard the management of Suzlon speaking to us. Where are you placed in this entire power generation theme? You want to bet on these power generators or this equipment suppliers like Suzlon and Inox Wind, or you want to bet on the power financiers like REC and PFC? Where are you placed here?
Yeah, unfortunately, we don't have any allocation to this entire space. We used to have significant allocation to generators as well as transmission company. But again, these are regulated entities, especially on the generation side and the transmission side. And roughly they make about 15% ROE. And so now when they trade at 3 times, 4 times book, it's just for a value portfolio like ours, it's difficult to justify holding them. We've actually exited them a couple of years ago from our portfolio. I know there's a transition happening to the renewable side. So there is, especially on the grid supply or players exposed to supplying equipment to the grid, there is significant demand uptick there. But when you look at their valuations of 60 times, 70 times earnings, I think a lot of that is already discounted, and there is disappointment possibly ahead in terms of growth not catching up to valuation at the end of the day.
Okay. Nilesh, hi, welcome to the show. Mazagon Dock Shipyard is reacting to its numbers and, F&O entrant as well. But separately, how would you approach the stock given, its defense play and that the stock is already outperformed, sitting at a gain of around 60% year to date?
Yeah, so again, we do not have any allegation to the defense space as such. I at least internally, the view is global defense spending will go up. India traditionally has grown, defense spending has grown in line with its normal GDP. So there is going to be one big buyer in India, in government of India, and its budget goes at a certain rate. And to assume these companies can go above that is not justified. We've not significantly seen a trend where defense spending outpaces GDP growth by a material number. So in that environment, if they were to match normal GDP growth rate, to give them the kind of valuation that they're getting, rivaling consumer staple companies, it seems very unrealistic to us. So our sense is it's actually a very frothy environment for defense stocks. In this current environment, I know a lot of the money is flowing in, including a lot of sectoral funds which have been launched, which are putting money in the defense space. But once sanity prevails, I think people will realize these companies are extremely overvalued.
So where are you putting money to work, Nilesh, in a market like this, which is in slightly consolidation mode, having recovered from the lows? Where are the sectors that you are betting on right now?
So our largest allocation remains private sector banks. We continue to have a significant weightage there, where at least in terms of valuation, they're trading at far below their long-term averages. We have allocated to the insurance space as well, where we found selective stocks which came to our buying limit. We continue to have an allocation to IT services. I know there are near-term concerns on what can happen as discretionary spend slows down in the US. But if you have a sort of 3 to 5 year horizon, current valuations do make a lot of sense. Where we think there's margin of safety if you're a long-term allocator. So these are the large places where we have allocated money.
Oh, okay. Just wanted to get a sense if you're looking at the entire banking space on IndusInd Bank.
Yeah, we hope there is a cleanup underway. See, it's a bank which has had historical problems as well, and it was a darling of the market, but it went through a significant correction, especially after COVID, as issues on non-recognition of NPA in the microfinance book even erupted then. So, and exposure to certain groups, which eroded the confidence in the market. Our sense is, hopefully, what is happening right now drives a cleanup in the bank, and valuation again remain very, very attractive. So it is a portfolio stock for us. We continue to hold it, and we think there is especially after the cleanup, once things normalize, there could be sort of a value unlocking that will happen in the bank.
Now, what about a lot of these new listings, Nilesh? Ola Electric is one of them. Losses continue to widen, although the guidance remains optimistic, but delivery or execution remains the concern. There are brokerages that are guiding for targets as low as 30 rupees on the stock. Where do you see this going for Ola, and what do you think is the key trigger now for any reversal in sentiment for a stock like that?
So we continue to actually have allocation to the traditional ICE-based two-wheeler. We reduce it as valuations become expensive. But again, distribution is such a big advantage in this space, and to create that overnight is not easy. And to be able to do after sales of all the two-wheelers in the market, which sort of helps build a brand, again, it's a long-term process. It's not an overnight process. Some of the new players have jumped the gun and sort of flooded the market with the products, then realizing we have to service them as well. So we continue to believe that the existing players or incumbents have a big advantage, and our allocation continues to favor them over the newer players that are.
Okay, all right. Nilesh, also wanted your thoughts on a couple of these pharmaceuticals counters. You know, the CDMO plays, they all are in focus on the possible opportunity from, say, GLP-1 drugs. So how would you play, a company such as Syngene, as well as OneSource, as well as Cohance? Are they companies that you have in your portfolio?
Not the CDMO players. We continue to have the traditional generic players. So, I mean, there were selective opportunities which came up when there was significant pricing competition in the US. Valuations for these players came off. Then we added them to the portfolio. They have done well for us. They've valued a bit. Again, there are some concerns emerging now on what can happen under sort of the new president and his policies targeting the pharma sector. But again, we favored traditional IT generic companies exporting to the US. And again, it's been stock specific. It's not that we have a view on IT generics being a place to be invested in. It's selected stocks which came in at different points in time where we found valuation comfort. We allocated them. The entire CDMO space has always been very expensive for us.
But wouldn't you take, wouldn't a pure play generics company be a risk, considering that what could emerge when it comes to Trump and the tariff situation? And from that aspect, which are the other sectors which could probably be at risk?
Again, the assumption is there are alternatives to Indian generic suppliers. We do not believe there are. I think even whatever policies come through, I think there is no alternative available to Indian generic suppliers in the US. And I think if there are tariffs imposed, I think Indian manufacturers will find a way around it, by either passing on the cost or absorbing some of it. And some of them have already created manufacturing bases in the US. So our sense is that the discount and valuations that they're getting for the perceived risk may not be best at all.
All right, Nilesh, thank you so much for sparing time and joining us today. Look forward to having you more often on this platform. Take a short break. On the other side, we continue our conversations on the markets. But just before we do that, we are excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset and for the Global Lens at 8:30 p.m.
Welcome back. Well, for the markets, nothing more to incrementally talk about except for the fact that Apollo Hospitals is now your top gain on the Nifty, up around 0.5%. So watch out for that. And on a week-to-date basis, there are a couple of stocks which have done well. Adani Ports, IndusInd Bank has seen a bit of a comeback, so it's up around 3% close to it on a week-to-date basis. And L&T also, Larsen & Toubro, is up around 1.8%. Divi's also has picked up pace post its numbers especially, so that stock is up around 1.5% for the week. In terms of the broader markets, a couple of outperformers week to date. MMTC up 18.5%, IFCI up around 8% on a 21% on a week-to-date basis, and MMTC is up 35% this week. So that's what's taking place in terms of the markets. But let's focus on some specific news. The centre has allocated around 3,481 crores under the PM E-Drive scheme to deploy 11,000 electric buses across 5 cities of Bengaluru, Delhi, Hyderabad, Ahmedabad and Surat. Our colleague Abhimanyu spoke to the Heavy Industries Minister, H.D. Kumaraswamy, on this. Listen in.
PM E-Drive's third flagship program. Recently, we had a meeting. In the budget, they have allocated our finance ministry 10,800 crores. In that, 3,481 crores for electric e-buses. We have actually allocated the amount. More than 14,000 buses we are going to distribute now. In first phase, we requested 9 cities. That is from Maharashtra, then West Bengal, Chennai, Ahmedabad, Surat, then Pune, Maharashtra, then that Karnataka and Telangana. Out of 9 cities, 5 city government machinery from Transport Ministry, they have approached us. Karnataka, they requested for 7,000 buses. Highest demand from Karnataka, they are requesting. Then Telangana also, they requested first 2,000, then they enhanced it to 2,800. Delhi, lastly, they approached, they are actually requesting for 2,800 buses. Surat, 1,000 buses they requested. 600 buses. Ahmedabad, 1,000 buses they requested. Out of this, Ahmedabad and Surat, 100% what they requested, we have decided to allocate all the demand. Then Telangana, we allotted 2,000 buses in the first phase. Karnataka, 4,500 buses in the first phase we allotted. We are still requesting West Bengal, Chennai and Maharashtra. But from West Bengal, personally I also requested, advised the Chief Minister West Bengal to send a proposal from them. But some judicial controversy from FAME 2 is going on. That is not settled. For that, Madam is little bit, after clearing that judicial thing, then only she decide. That is the reaction from West Bengal. Then Chennai, the Tamil Nadu government, they are actually getting some World Bank loan. On their own, they wanted to take the decision to allot the buses for the common man there actually. This is the issue. Another 3,800 buses we have to allot. What demand will come from other cities? We are waiting for that.
So what is the per bus subsidy which is going to be given and the total subsidy outlay from the ministry's side?
The subsidy issue we are working out. Now we have to call tender also. For that actually time guidelines we have put actually. After that only we will decide actually how much they will get. But 10 years this scheme will be in the process actually to get some subsidy.
So my final question to you, the initial plan was for 14,000 buses. Is there going to be a fresh allocation as well after the current announcement?
No, first phase actually the demand from the state. For that actually we have took the decision. Another remaining 3,800 buses, next demand from which state it will come, we will try to allot them. We are actually requesting West Bengal, Maharashtra. If they come actually we will consider their request also. Otherwise, even Karnataka they are requesting some more buses. Even Telangana Chief Minister is requesting another 800 buses. For that actually second phase, the demand from other cities, if it comes, actually we have to allot them. If the allotment is actually, if any buses actually remain, we will going to allot the demand from other our present cities.
H.D. Kumaraswamy there in conversation with CNBC TV18. But one of the earnings reactions of the morning has been Ola Electric, and that continues to remain lower after a weak fourth quarter fine print. Sudarshan is now joining in to tell us more on that. Sudarshan.
So it's under pressure after reporting an operational weak Q4, but the outlook that company has given for Q1 FY26 is looking healthy. But talking first about Q4 FY25, losses have expanded both on a sequential basis as well as YOY. Losses for Q4 FY25 were at rupees 870 crore versus rupees 416 crore that company had reported in Q4 FY24. Revenue was down 62% and EBITDA losses increased to rupees almost 700 crore against loss of rupees 312 crore. Now coming to the outlook that company has given for Q1 FY26, it believes that adjusted revenue growth, that is revenue growth in Q1 FY26 against Q4 FY26, might be in the range of 23 to 31%. Deliveries can increase by 28%. Adjusted gross margin can increase to in the range of 28 to 30% from 19.2%. Auto EBITDA margin may be minus 10% against 78.6% that company has reported in Q4, and consolidated EBITDA margin may be minus 25% versus minus 101.4%. Also, it believes that gross margin may improve further, and in Q2 FY26, it may hit the level of 35%. Also, in FY26, company believes that its auto segment will turn EBITDA break even. So, outlook is healthy, but on the basis of Q4 FY25 earnings, you are seeing a sharp downtick in the stock price.
Still continuing to hold on to that 50 rupee mark though, Sudarshan. Thanks a lot for that. But stay on because Bajaj Auto is also in focus after its fourth quarter results. Tell us more on that.
Bajaj Auto, as far as earnings for Q4 FY25 are concerned, earnings looked very steady. Company has managed to hold on to margin of 20% for the sixth straight quarter. Even revenue that it saw double-digit growth in few segments like commercial vehicle, electric two-wheelers and premium motorcycles. But due to temporary suspension of KTM exports, Q4 FY25 revenue growth has come just at 6%, but it was above estimates. Also, profit was above estimates. Margin too has come at 20.2% against our estimate of 20.1%. And also, good parties realization was higher against the estimate. It has increased 2% year on year, and also on a sequential basis, it was up 5%. Talking about the outlook, company is saying that domestic industry growth for FY26 is seen in the range of 5 to 6%, almost at the same level that industry had grown de-grown in FY25. But positive part for Bajaj Auto is in 125cc plus segment. That is the focus area for the company, where it's saying that industry is likely to grow in the range of 8 to 12%. But company believes that it will outperform the industry. But one more thing that will be in focus is saying that rare earth magnet supply from China, because it's a concern. And if there is any disruption in the supply, it will disturb the output from the month of July. And that's one of the main reasons that stock is under pressure today.
Okay, all right. Thanks for that, Sudarshan. So that's on Bajaj Auto. That's one of the top losers on the Nifty. But defense shipbuilder Mazagon Docks also reported weak numbers in its fourth quarter earnings. Ria's here with the fine print.
Well, yes, Mazagon Dock has reported a very weak set of numbers in quarter 4, although the full year performance has remained healthy this time around. Coming to the Q4 numbers first, profitability has been sharply lower this time around. EBITDA and net profit have fallen by 83% and 51% respectively, both on a year-on-year basis. EBITDA margins have also contracted by over 1,400 basis points on a year-on-year basis this time around. They've come in at just 2.8% versus 17% that we saw in Q4 last year. Even on a sequential basis, margins have declined by around 2,300 basis points. The profitability has been impacted this time around by significantly higher expenses. The subcontracting expenses have gone up by over 9 times on a year-on-year basis. Even some other project-related expenses have gone up by around 4 times, and provisions have also gone up by around 5.6 times compared to Q4 of last year. Now, in the earnings call for quarter 3, the company had said that these provisions have been created with regard to excess inventories from ships with expired warranties. And while the components are still in good shape and may be used for future projects, the provisions will be reversed upon utilization. Now, coming to the full year performance, that has remained quite healthy. Revenue has gone up by around 21% on a year-on-year basis, above the guidance of the company of around 10 to 12% growth. EBITDA margins have also come in at 18%, showing a growth of around 300 basis points compared to the previous year, again above the company's guidance of 12 to 15% margins. Now, the total order book, that stands at about rupees 34,780 odd crores at the end of quarter 3, so that remains quite healthy. And the company also has some other huge orders on the anvil for the next 1 to 2 years, which include the Kalvari class submarines, the P-75I submarines, as well as the next-gen corvettes. So that is something to be watching out for. And today, of course, we will be watching out for further management commentary in the earnings call post-market hours.
Yes, most awaited. Ria, thanks a lot for that. Snapping a 7-day gaining streak, Mazagon Dock ending at a record high in yesterday's trading session. So now seeing some bit of profit booking, of course, the first day in the F&O segment as well. Take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away. And that, of course, is that CNBC-TV18 all-new app where you get breaking news updates, in-depth articles, and financial world stories, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that's up on your screen. Take a short break, back on the other side. Well, still looking to end the week on a dull note. The Nifty Bank, though, has recovered slightly from the lows of the day. It's almost now about to move into the green is the Nifty Bank, and that is showing up on the Nifty as well. Still 75 points lower, still holding on to that 24,750 mark. And there are plenty of stock-specific reactions. Gujarat Pipavav is now at the highest point of the day. 10% higher now on that stock, the top gainer on the Nifty 500. With that, we call time on this edition of Trading Hour. From Ektami and the team that put this show together, thank you so much for watching. Halftime report for the next 60 minutes.